What you are looking at are not just two different industries, they are two different realities. On one side, the old world, a citadel of centralized power built over centuries, governing the flow of global capital with an iron will. On the other, the new frontier, a promised land of decentralization built on code, challenging every assumption about value, trust, and ownership. They have been portrayed as eternal enemies, locked in a war for the soul of money itself. But what if the most dangerous thing isn't the war? What if the most dangerous thing is the peace treaty? Now, a single entity, the most powerful and controversial bank in modern history, JPMorgan Chase, has crossed the Rubicon. It is not just buying Bitcoin. It is not just offering crypto custody. It has launched a weapon so sophisticated, so perfectly calibrated, that it has left both crypto evangelists and Wall Street traditionalists staring into the same abyss of a single terrifying question. Is this the ultimate validation of a trillion-dollar revolution, or the most elegant takeover the financial world has ever seen? This is the story of JPMorgan's tokenized crypto fund. It's a story hidden, not in dark web forums, but in bland SEC filings. Its architects aren't hoodie-clad hackers, but billion-dollar bankers in corner offices, and its implications could redefine the meaning of money for generations. To understand it, you must first abandon everything you think you know, and follow the money into the Shadowlands, where the old guard and the new rebels are forging an alliance where only one side can possibly win. The year is 2023. The crypto winter is deep. FTX has evaporated, taking $32 billion in perceived value and the reputation of an entire movement with it. Regulators are circling like hawks. The media narrative is unanimous. Crypto is a failed experiment, a speculative toy, a haven for criminals and dreamers. In this climate of maximum fear and distrust, the titans of traditional finance did what they always do. They waited. They watched the blood run in the streets. And then they moved. On a day that should have sent seismic shocks through the financial press, but was buried under more sensational headlines, JPMorgan, the bank that once called Bitcoin a fraud, and worse than tulip bulbs, executed a maneuver of breathtaking audacity. Through its asset management arm and leveraging its blockchain division, Onyx, it launched the JPMorgan Digital Treasury Fund. This wasn't just another fund. This was a tokenized representation of a traditional money market fund, issued on a private, permissioned blockchain. In simple terms, JPMorgan created a digital twin of a staid, boring, ultra-safe investment vehicle and placed it on a cryptographically secured ledger. The initial numbers were modest, almost a pilot program, but the mechanism was everything. The fund's shares were represented as digital tokens on the JPMorgan Ethereum-based private blockchain. Each token was a digital bearer instrument, meaning ownership was proven by holding the cryptographic key, not by an entry in JPMorgan's centralized database. These tokens could be traded 24/7, not just during New York Stock Exchange hours. Settlement, the final transfer of ownership in cash, which traditionally takes 2 days, T+2 in the legacy system, was instant. Poof! The friction of the old world erased with a line of code. Why is this revolutionary? Let's dissect the anatomy of this new creature. A traditional money market fund invests in short-term, high-quality debt like government treasury bills. It's a parking spot for cash, designed for stability, not moonshots. By tokenizing it, JPMorgan did something profound. It attached the liquidity, innovation, and programmable potential of a crypto asset to the regulatory clarity and underlying safety of a century-old financial instrument. It was a hybrid, a chimera, a financial drone strike that hit a target nobody realized was vulnerable, the very infrastructure of ownership. The technical mechanism is called Tokenization of Real-World Assets, RWA. It involves creating a digital token on a blockchain that serves as an immutable, transparent claim on an underlying physical or financial asset, be it a treasury bond, a share of stock, a bar of gold, or real estate. The blockchain acts as the unchangeable ledger of truth. Smart contracts, self-executing code, can automate everything from dividend payments to compliance checks. This isn't theory, it's operational reality inside the black box of JPMorgan's Onyx platform, which has already processed over $1 trillion in short-term loan transactions since its 2020 launch. $1 trillion. A test run conducted in plain sight. But to see this as merely a technological upgrade is to miss the forest for the trees. This is about power. Institutional behavior follows patterns, and JPMorgan's pattern is a textbook study in co-option and control. Let's rewind the tape. In the late 1990s and early 2000s, Wall Street banks grew frustrated with the transparency and pricing of public stock exchanges. Their solution? Create private, off-exchange venues called dark pools, where they could execute large block trades away from the prying eyes of the public market. They sold it as a way to get better prices for clients and reduce market impact. The reality was a fragmentation of the market, a loss of price transparency, and a massive accrual of informational advantage to the banks that owned them, JPMorgan was a leader with its JPMX platform. The playbook: identify an inefficiency or a threat in the public system, create a private, controlled alternative that offers perceived benefits, and gradually siphon value and influence away from the open ecosystem. Sound familiar? Now, replace public stock exchange with public permissionless blockchains like Ethereum or Bitcoin. The inefficiency: slow, expensive, legacy settlement systems. The threat: decentralized finance, DeFi, promising to disintermediate banks entirely. JPMorgan's response: create a private, permissioned blockchain, Onyx, offer a faster, cheaper, more controlled alternative, tokenized funds, and begin the process of siphoning the most valuable, institutionally palatable activity away from the public chains. This isn't an attack, it's an enclosure, a digital enclosure of the commons of trust that crypto promised, the hidden forces and secret decisions. The real story of JPMorgan's crypto fund is not in the press release, but in the quiet, relentless buildup over half a decade. While CEO Jamie Dimon made headlines dismissing Bitcoin publicly, a secret war machine was being built inside the bank's walls. 2015, JPMorgan develops its first blockchain prototype, a fork of Ethereum. Internally, hundreds of millions were poured into research. In 2019, the creation of the JPM coin, a digital token representing a US dollar deposit with the bank, a stable coin, but one issued by a bank for institutional clients only. This was the foundational brick. It proved they could create a digital currency that lived within their regulatory and operational fortress. 2020, the official launch of Onyx, a full-fledged business division dedicated to blockchain and digital assets. This was the battalion mobilized. 2021-2022, the acquisition of strategic assets. Most notably, the acquisition of 55 IP, a fintech firm specializing in tax-smart investment technology. Why? Because programmable money needs programmable tax optimization. Every piece was a strategic move on a chessboard only they could see in full. And they were not alone. Behind the scenes, a quiet consensus was forming among a cabal of the world's most powerful financial institutions. BlackRock, the $10 trillion behemoth, was laying its own groundwork. Its CEO, Larry Fink, underwent a public transformation from crypto skeptic to evangelist, stating that tokenization of securities could be the next generation for markets. In 2022, BlackRock partnered with Coinbase to offer crypto access to its institutional clients. In 2023, it filed for a spot Bitcoin ETF, a move seen as the holy grail of mainstream adoption. This was not a coincidence. It was a coordinated, if unspoken, institutional pivot. The legal and regulatory battlefield is where this war is truly being decided. And here, the institutional behavior reveals its most potent form: regulatory capture through superior resources. While crypto startups like Coinbase and Ripple spend hundreds of millions fighting the SEC in brutal public court battles, JPMorgan operates differently. It doesn't fight the regulators. It embeds itself within the regulatory framework. It hires former SEC chairs and senior officials. Its lawyers help write the proposed rules. Its tokenized fund is deliberately structured not as a wildcat crypto asset, but as a traditional fund that uses blockchain as a technological utility. This allows it to navigate within existing securities laws, the 1940 Investment Company Act, a framework as old as World War II. It's a legal sleight of hand so masterful, it's almost artistic. They aren't asking for permission to play a new game. They're subtly redefining the old game so that only they have the rulebook. In the 1990s, JPMorgan bankers in London, led by a team trying to free up regulatory capital, invented a new financial instrument, the Credit Default Swap, CDS. It was a private contract, opaque, traded over the counter between banks. It was sold as a tool for risk management, a way to make the system safer. For years, it operated in the shadows, unregulated, growing into a multi-trillion-dollar market. By the time the world understood its systemic danger in 2008, it was too late. The pattern: innovate in the shadows, create a complex private instrument that offers short-term profit and efficiency, grow it to a scale where it becomes too important to fail, and only then face regulation on your own terms. The private permissioned blockchain is the new over-the-counter market. The tokenized fund is the new CDS. It starts small, contained, beneficial. The efficiency gains are real. But as more assets, trillions in bonds, stocks, and real estate, are tokenized onto these private ledgers controlled by a handful of institutions, a new, even more opaque and concentrated financial system emerges, one where JPMorgan and its peers are not just the intermediaries, but the architects, the operators, the rule makers, and the exclusive beneficiaries of the very plumbing of finance. So we return to our central terrifying question: invest or avoid? For the institutional investor, The pension fund, the insurance company, the sovereign wealth fund, the JPMorgan fund is a revelation. It's a bridge into digital asset efficiency without stepping into the perceived lawlessness of the public cryptosphere. It offers the holy trinity: yield, liquidity, and the imprimatur of the most powerful bank in America. The data is compelling. The Boston Consulting Group estimates the tokenized asset market will be a $16 trillion business by 2030. To avoid this is to avoid the future, to cling to a slower, more expensive past. For them, the answer is unequivocally invest. But for the individual, for the believer in the original cypherpunk ethos of crypto, of decentralization, censorship resistance, and self-sovereignty, this fund is the ultimate trap. It is a siren song of convenience that lures you onto the rocks of absolute centralization. You get a token, but you don't get freedom. The blockchain is private. JPMorgan controls the validators. They can reverse transactions. They can freeze your tokens to comply with regulatory requirements. They are the absolute arbiter of truth. This is not Web 3. This is Web 2.5, a more efficient version of the exact system crypto was invented to destroy. To invest in this is to finance your own prison warden. For the true believer, the answer must be avoid. This is the pivotal moment. We are not witnessing the adoption of crypto by the old guard. We are witnessing the absorption of crypto's most useful innovations by the old guard to fortify its own walls. The battle is no longer between Bitcoin and the dollar. It is between two visions of a digital future. One of open, permissionless, decentralized networks, and one of closed, permissioned, institutionally controlled ledgers. JPMorgan's fund is the beachhead for the latter. The public, permissionless blockchains like Bitcoin and Ethereum have one final, unassailable advantage. They are credibly neutral. No one, not Jamie Dimon, not the president, can change their rules or seize your assets if you hold your keys. That is the nuclear option. That is the value proposition that cannot be tokenized or enclosed. It is messy, volatile, and often inefficient. But it is freedom. And as the great financial institutions erect their gleaming, efficient digital towers of control, that chaotic, decentralized wilderness may become the most valuable territory of all. The story of JPMorgan's tokenized crypto fund is not a financial bulletin. It is a prophecy. It is the opening chapter of the next century of finance, written in code by the victors of the last. The question for you is no longer just invest or avoid. The deeper, more urgent question now echoes through the digital halls of power and the encrypted messages of the decentralized resistance. When the new world is built, will you own a key to the kingdom, or will you simply live in it at the pleasure of the king? If this changed the way you see money, don't stay silent. Subscribe for deep dive intelligence they don't want trending, because the next shift won't come with a warning.